Welcome back to the deep dive. Today, our mission is really laser focused. We're not looking at the whole picture, not product strategy or anything like that. We are digging into the financial bedrock of a major company, and we're going straight to the source. We've got the transcript from the third quarter 2025 earnings call, and we're zeroing in on the detailed remarks from the chief financial officer.
Okay.
Okay, so let's unpack this. The goal here is to cut through, the usual noise, get past the bullet points, and really pull out the key financial takeaways. We want to understand the blueprint, right? How this company is turning sheer scale, which we've heard about for years, into actual concrete financial results. It's that leverage story we're really after today, not just growth.
That's exactly it, yeah. But for anyone listening who's focused on profitability, on, structural stability, this dive is all about the why these numbers. We're hunting for the proof points, the signs that show a real shift in the business model, moving away from just high burn growth towards what they're now calling a truly scaled, profitable, and structurally sound financial operation.
Okay, let's start right at the top then. The headline achievements. When the CFO got up to speak, what was the main message, the primary signal about Q3?
Oh, the signal was loud and clear. Record performance. Pretty much across the board. They hit new company records for retail units sold, total revenue, adjusted EBITDA, and GAAP operating income, all records. But I think the biggest marker, the one signaling maturity, was hitting an annual revenue run rate over $20 billion for the first time ever.
Wow.
Yeah. That number really frames the scale they've achieved, their market penetration.
Okay, and here's where it gets really interesting for me. The top line growth, they sold a lot of cars, but the revenue growth actually jumped even higher, significantly higher.
Right. So retail units sold were 155,941. That's strong, no doubt, a 44% jump year over year. But then revenue hit $5.647 billion, and that's a 55% increase.
Okay, so that gap, 11 percentage points difference between unit growth and revenue growth. That needs explaining.
Exactly. When you see that, you immediately think, okay, either prices went way up or something changed in how they account for things.
And what did the CFO say was driving that?
Well, it was a bit of both, really. They mentioned higher average selling prices, sure, but a big piece was also the accounting treatment, specifically the traditional gross revenue treatment for some vehicles they got through a big retail marketplace partner.
Okay, can you unpack that a little? Traditional gross revenue treatment. Sounds technical, but seems like it had a major impact on that top line number.
It really does. Basically, instead of netting out what they paid for those specific cars, which would make the revenue number lower, they booked the full selling price as revenue. So yeah, it inflates that top line, that $5.647 billion, pretty aggressively.
Yeah.
But also shows the scale of those partnerships, right? It reflects how they're expanding their inventory sources. It's a strategic choice, really.
Got it. And beyond just the numbers, the CFO made it clear this wasn't just luck, it was strategy. What were the core drivers they kept pointing to?
They kept coming back to three things, three long-term drivers. One, constantly improving the customer offering, making it easier, better to buy a car. Two, building more understanding, awareness, and crucially, trust in the brand. And three, really leaning into the benefits of their scale, like offering way more choice, more inventory selection. Those three pillars, that's the engine driving these financial results.
Okay, let's shift gears. Selling more is great, but if it costs you more and more to do it, well, that's not sustainable. Efficiency, operating leverage, that's the proof. How did they show leverage in their SG&A expenses, selling general and administrative costs?
Yeah, this is really the key section for seeing if the model works long term. That 44% unit growth we just talked about, it led directly to a pretty substantial $319 reduction in non-GAAP SG&A per retail unit sold.
$319 less cost per car sold?
Per car sold, yeah, compared to last year. So for every car, their overhead and operating costs dropped by over $300. That's significant leverage. And if you break down where that $319 came from, it really tells the story. You've got the Carvana operations part of SG&A, think logistics, vehicle processing. That improved $96 per unit because of specific efficiency work. But the real leverage, the big chunk, came from the overhead portion.
Okay, why is that overhead piece so critical?
Because overhead is your fixed costs, right?
Yeah.
Corporate offices, tech platform, central staff, stuff that doesn't directly scale with each car sold. So when your volume explodes like theirs did, you spread those big fixed costs over many, many more units. The CFO reported a major decrease there per unit, much bigger than the operational savings. It confirms they're really sweating those big, expensive assets they've built. That's the clearest sign, financially speaking, that they're making that transition to a scaled, leveraged platform business.
that makes total sense. Like built this huge factory, and now they're finally running it near full capacity. But hang on, one number went the other way. Advertising expense per unit actually increased by $139. That seems, well, pretty counterintuitive when they're focused on cutting costs elsewhere. Why spend more there?
Yeah, it's a really interesting trade-off they're making. They were very clear about it. They call that advertising increase a strategic investment, the goal, to build that awareness, understanding, and especially trust they mentioned earlier. They're basically using their stronger financial position now to push hard on capturing market share and locking in their brand image.
So it's like the savings they found in overhead efficiency are basically funding this bigger push on marketing,
Yep.
shifting resources.
That seems to be exactly the thinking, yeah. They seem comfortable taking that short-term expense hit because they believe it fuels the long-term scale, which in turn helps them maintain and even deepen that overhead leverage down the line. And the guidance backs this up too. They said Q4 advertising spend would be similar to Q3, maybe even a bit higher. So they're keeping the pedal down on visibility.
Okay, let's pivot then to gross profit per unit, GPU, the margin story per car. The CFO broke it down, retail, wholesale, and other. What were the headwinds in the main retail and wholesale parts?
Well, both retail and wholesale GPU actually dipped a bit year over year. Not drastically, but down. The main reason they cited was the macro environment, specifically, higher depreciation rates impacting used car values. So the cars they were holding were losing value a little faster. Retail GPU was down $77. Wholesale GPU down $168. And for wholesale, it was also compounded a bit because their retail growth was kind of outpacing how fast they could scale up the ADESA marketplace side.
Okay, but the other GPU part, that actually went up by 63 Browns. That's usually finance, warranties, that kind of thing, right? What drove that increase?
Exactly. Ancillary revenue. That positive bump came from two key things. One, better cost of funds, basically. Their financing arm is getting cheaper capital. And two, maybe more importantly, higher attach rates for finance and VSC's vehicle service contracts. They're just successfully selling more of those profitable add-ons when they sell a car. But here's something fascinating they mentioned looking forward. Tied to that finance platform, they specifically said they plan to share, and I quote, fundamental gains with customers through lower interest rates in Q4.
Lower interest rates, so give back some potential profit.
Precisely. It raises this really interesting strategic question for you
Yeah.
listening. They're choosing potentially lower other GPUs in Q4 to try and drive more sales volume, maybe convert more customers who are rate sensitive. It's a conscious trade-off.
Yeah.
Volume versus maximizing margin on each deal.
Interesting. Okay, let's look at the foundation for all the balance sheet. They seemed keen to highlight steps they took in Q3 to really shore things up financially, deal with debt.
Oh, absolutely. Debt management was a huge theme. They paid off the rest of their 2028 senior secured notes. It was $559 million gone during the quarter. And then after the quarter ended, they retired another $98 million of their 2025 unsecured notes.
So pulling back aggressively on debt, what's the net effect on their overall financial risk?
It means they've wiped out $1.2 billion in corporate debt just in 2024 and 2025. That's significant. Combine that with having over $2.1 billion in cash sitting on the balance sheet, and, well, their key leverage ratio, net debt to trailing 12-month adjusted EBITDA, is down to just 1.5 times.
1.5 times.
Yeah. The CFO didn't mince words, called it their strongest financial position ever. And that ratio, well, it certainly points to a much less risky business profile. They're moving towards much healthier credit metrics.
And maybe the proof of that renewed strength is how the market reacted, specifically those massive loan sale partnerships they locked in. We're talking $14 billion in future loan principal commitments. It's huge.
It's enormous. It's a massive vote of confidence from big financial players in their ability to originate good quality auto loans. They expanded their deal with Ally up to $6 billion running through 2027. And then they added two new partners, completely separate deals, each for up to $4 billion.
Wow.
Yeah. What this does is it basically guarantees a pipeline for selling those loans off their books, ensuring they have the capital flow for their finance arm, almost regardless of, market swings. It really solidifies that whole finance platform.
Okay, so let's bring it all together. Scale, getting leverage on costs, managing debt, securing funding. What did this actually translate to in terms of bottom line profitability records in Q3?
Well, the results were pretty definitive. Proof that profitability at scale is achievable for them. Adjusted EBITDA hit a new record. $637 million. That's an 11.3% margin, which is quite healthy. GAAP operating income, also a record. $552 million, a 9.8% margin. and net income landed at $263 million, which works out to a 4.7% margin. And they made a point, an important one, I think, about the quality of that EBITDA. They stressed it has relatively low non-cash expenses baked in.
Meaning more of it is actual cash.
Exactly. Most of that reported EBITDA is translating into real cash flow. And that's exactly what you want to see when a company says it's focused on paying down debt and funding its own growth.
Right. So looking forward then, what signals did the CFO give about Q4 in the full year, assuming, the world stays relatively stable?
They guided for Q4 retail units sold to be above 150,000. So still very strong volume, even heading into what's usually a slightly slower time of year for car sales. And for the full year 2025, they expect adjusted EBITDA to land at or even maybe above the high end of their previous range, which is $2.0 to $2.2 billion.
Okay, so basically confirming they expect these Q3 efficiency gains and profitability levels to stick around, maybe even improve slightly.
That's the message, yeah. Confidence that the structural improvements are holding.
So this deep dive really laid out a financial blueprint, didn't it? Not just growth for growth's sake, but showing real structural maturation. We saw record revenue, yes, but then how that translated into, well, pretty incredible leverage on their fixed costs. And that leverage, in turn, freed up cash for them to be strategic investing in advertising on one hand and aggressively paying down debt on the other.
Yeah, and if you connect it to the bigger picture, those huge loan partnerships, the $14 billion plus the $2.1 billion cash pile, it really suggests they're pushing hard to de-risk the business now, strengthening that foundation so they can handle whatever the economy throws at them next, while still feeling confident enough to keep pushing for more scale.
Okay, so here's a final thought, something for you to chew on. They explicitly said they plan to pass on some fundamental gains to customers through lower interest rates in Q4. That's a clear choice, right? Sacrificing a bit of margin, hoping for more market share. So the question is, will that strategic pricing actually work? Will it bring in a flood of new customers? And if it does, will that extra volume be enough for them to maintain these record efficiency levels, even while giving up a slice of profit on each car? It's a fascinating balancing act to watch unfold as they head into 2026.